Principles of Accounting 2, Chapter 13, Examples. In Chapter 13, we talk about many of the different decisions that a company might have to make and how we can look at those decisions from a financial perspective. We look at what is the incremental or differential cost or revenues. So what is different from the two decisions? We only look at the relevant information or costs. So we don't analyze all of the information. So the first example that we're going to look at is dropping a product or a segment. So we have information about a company that manufactures 3 types of bicycles. And we have a statement here, an income statement for each one of the product lines. We're also given information that the allocated fixed expenses are allocated on the basis of sales dollars. And we see that the racing bikes line has a net operating loss instead of a net operating income. So we see that management is concerned about the continued losses shown by the racing bikes, and they want a recommendation as to whether or not the line should be discontinued. So we need to consider what the relevant information is to make that recommendation. So we can determine what is the financial advantage or disadvantage per quarter of discontinuing the racing bikes. So we need to look at this income statement and decide what is relevant about that decision. So if we eliminate the racing bikes division, we eliminate their sales and their variable expenses. So we eliminate their contribution margin to our bottom line. So we have lost contribution margin. And we're going to look at that as a negative number. So right now, the contribution margin is a positive thing for our company's bottom line. It contributes to our ability to pay fixed expenses. We're going to lose $27,000 in contribution margin. We also are going to lose whatever fixed expenses are attributed to the racing bikes division. So remember, from many chapters that we've looked at, when we're looking at segments, we have 2 different kinds of fixed expenses. We have fixed expenses that are only part of the segment that will go away if the segment is closed. And then we have fixed costs that are part of the company and we have to keep no matter what decision we make. So we call those in decision making avoidable fixed costs and unavoidable fixed costs. So we want to focus on the costs we can avoid or get rid of by getting rid of the division. So those costs include anything that says it's traceable. So this traceable advertising cost is an avoidable fixed cost. So we would save $6,000 in advertising if we closed the racing bikes division. Depreciation is considered a sunk cost. Depreciation is based on a historical purchase of equipment. Historical costs are costs that cannot be recovered and are called sunk costs. Sunk costs are not relevant to decision making and shouldn't be considered when we're making a decision. So we're not going to pay any attention to that depreciation. The product line manager. If we don't have a product line, we don't need a manager for that product line. So we're going to save the product line. And then common fixed costs. So common fixed expenses are allocated to this department. They're still going to be part of the company's bottom line and they can't be avoided. So we have all of the relevant information for what we're going to lose in revenues and which costs we can eliminate. So the financial advantage or disadvantage that the problem is asking for. We can determine that if we add these three numbers together. We're going to add these three numbers together, and we discover that it is a financial disadvantage. We're going to lose $11,000 if we close the racing bikes division. So that's the answer to question 1. It's a financial disadvantage of $11,000. So 2 says, should the production and sale of racing bikes be discontinued? I would say that the fact that it's a financial disadvantage to us, that I would say no. 3 asks us to prepare a properly formatted segmented income statement that would be more useful to management in assessing the long-run profitability of the various product lines. So if you remember from previous chapters where we looked at segment division, where we separated out those controllable and uncontrollable fixed costs, or the difference between the traceable and the allocated fixed costs, and we had segment margin, then that is what it is asking us to do. So I'm going to do a shortcut by copying and pasting the top portion of this income statement here. So now we have the contribution margin and the controllable fixed cost, or traceable fixed cost. So the cost that the manager should be evaluated on. Add those together. And then our segment margin is contribution margin minus our traceable or controllable fixed cost. Then we have our common fixed cost, but in a segment margin income statement, we only add our common fixed cost to the total. We don't allocate them out to the different segments. And then we have the company's net operating income as a whole. So we see if this company started making segmented income statements, they could see that the racing bike division is not actually losing money. In fact, the reason it looked like they were losing money was because of the way that common fixed costs were allocated. And it's possible if we allocated those common fixed costs in a different way that we wouldn't be losing money in this division. Remember, it's up to a company to decide how they allocate those common fixed costs. You see that they allocate those fixed expenses on the basis of sales dollars. So if you remember the chapter where we talked about allocating service department costs and fixed expenses, we determined that sales dollars were the most ineffective way to allocate those. In fact, it's highly recommended that companies don't use that as an allocation method. Companies can use whatever method they want, and if they want to use sales dollars, they can do so, but it's not the recommended way. The recommended way is on the basis of the utilization of the resource. So they can find a different way to allocate overhead that makes better use. We also know that common fixed cost allocation should not be considered as part of a product segment or manager's evaluation because those costs can't be avoided and are not under the control of the individual division. The next decision that we're going to look at is a make or buy decision. In a make or buy decision, we have to decide if we're going to make parts in-house or if we're going to buy them from an outside supplier or outsource them. One of the things that we need to consider in a make or buy decision is an opportunity cost. So what is our opportunity if we no longer make this item? What can we use that increased capacity for if we're not making that item? So we have information about a part, per unit information, and per 15,000 units per year. We've also been told that what an outside supplier has offered us this part for $35 per unit. We are also told that 1/3 of these traceable fixed manufacturing overhead is supervisor salaries, and the rest is depreciation. So if we remember, depreciation is not a relevant cost. So when we're looking at what is relevant and not relevant in this decision, we need to remove the 2/3 of that is depreciation from our amount. So the first question we're asked is, assuming the company has no alternative use for the facilities, what would be the financial advantage or disadvantage of buying 15,000 carburetors from the outside supplier? So this means we have no opportunity cost, and we're just doing a cost evaluation between the make or buy. So we're going to look at make versus buy. We'll do a per unit and then for the entire 15,000 units. So first we have, what are the relevant costs to make it? Well, relevant costs are traceable costs. So if you remember, traceable costs are variable costs. So every variable cost we have is relevant to this decision. What would we not have if we didn't make this product? Well, we would not have the associated materials, labor, or variable overhead. So all variable costs are relevant to our decision. Then we also have the supervisor salary. So traceable costs are relevant. So traceable fixed costs would be relevant. But we know that depreciation is not relevant. So we need to remove the depreciation from our traceable fixed costs. So 1/3 of $6 is $2. So if we add up these costs, the relevant cost to make the part is $29. The relevant cost to buying the part is $35. And now at 15,000 parts a year, we can calculate the total cost of make versus buy. So the financial advantage or disadvantage is the difference between making them and buying them. So it's a financial disadvantage of $90,000. Question 2 says, should the outside supplier's offer be accepted? No. At a financial disadvantage of $90,000, we would not accept the outside supplier's cost. 3 says, what if we use the freed capacity to launch a new product? The segment margin of the new product would be $150,000 per year. What would be the financial advantage or disadvantage of buying 15,000 carburetors from the outside supplier under this situation? So this $150,000 is an opportunity cost to us now. If we continue to make the product, we give up this opportunity of $150,000. So we lose an opportunity that costs us $150,000. So now the cost to make them is $585,000. Well, the cost to buy them is $525,000. Now the difference is $60,000. So the advantage to buying them is $60,000. Given that assumption, should the outside supplier's offer be accepted? In that case, yes, it should be accepted because we are going to have that opportunity of $150,000 that covers part of the purchase price to the outside supplier.